Is this AI CapEx boom bigger than the 1999 internet boom? US macro data clearly says yes. Let's dig into this now with our chief equity strategist and economist, John Blank. John, you wrote recently in terms of US macroeconomic weight, the current AI infrastructure build out has actually surpassed the peak of the late 1990s internet boom as a share of the total US economy. So, has tech alone been responsible for the majority of the U.S. GDP growth, and for how long?
Gary, I would say it's responsible for half the GDP growth rate, which is 2%. So 1% of it is coming from this. And I would say it's probably 4 to 5 quarters long, and it looks like it will endure through the end of this year, but probably not next year. So it's probably a 6, 7, 8 quarter long surge, and we're probably 5 quarters through it.
So, for context purposes, what are the current AI capex spending levels for 2026?
Well, to the degree I can estimate them, I hear it's around 700 billion. So to get reference on that, 700 billion on a $32 trillion economy is effectively 2.5% of growth. But when it's all in addition to what's going on, you can then factor in that really is dramatic. So if I say it's 2.5% growth, and I told you it was 1% earlier, what's the difference here? The difference is in how it's get accounted for within the accounts, Terry. You actually have to book it in those quarters, versus announce it. That's what the difference is.
So, is all this driven by these data centers we've been hearing about, or is there more to it?
It is basically that, Terry. It's the data centers, and it's also just the internal, purchasing of chips and servers for the enterprise hyperscalers out there, particularly the United States. And that is what it amounts to, Terry. But there's also a lot of pushback. People got to realize people are very unhappy with these data centers, and a lot of these numbers that you're hearing in the news may effectively not come to pass going forward past the next 2 3 quarters.
So, by comparison, what was the internet investment at the dot com height?
Yeah, Terry. In U.S. terms, then it was about 400 billion. So there's your number. At the peak, it was 400 billion a year. We did 700 billion this year. Yes, there is, Terry. Excesses are the first thing you look for in predicting recessions in the future because people buy or spend too much, then they will pull back later from that expenditure. So I hate to tell everybody that, I'm always looking for excesses, but now we absolutely have excesses in the US economy. And this should concern all of us. And all these euphoric growth numbers in earnings and things that you hear in the news and all these capex numbers should actually be concerning for you that are worried about a recession.
You say there are two overvalued S&P 500 sectors to be aware of. Is tech one of them?
Tech is one of them. The other one is industrials. And if I said that 6 or 8 weeks ago, Terry, and of course, Michael Burry shorted Caterpillar, and we now know that Caterpillar shares have been plummeting along with the other trades because anybody who's going to build a data center is thinking cats, both power and their equipment are going to be involved. And so it got to be the case that it was just one big AI trade and it included a lot of these industrial names.
So, do you see stock valuations correcting near term?
Absolutely, Terry. I mean, we got to remember the Case-Shiller price earnings ratio, which goes back 10 years of earnings. So it averages the last 10 years of earnings, year to year, is at 40, which is like the dot-com period. This is very similar to the dot-com period. If you look at the large cap price earnings ratio on a forward look, it's 21 or so, 20 to 21. So what that's telling you, Terry, is basically half of the current earnings in the United States have a really poor quality, very transitory, and are being treated like a boom, but it's not appearing in the GDP accounts at all. It's last year we did 2.1% growth in real terms. This year we're looking at 2.1% in real terms, and next year we're looking at 2.1% in real terms. So again, this is just completely out of sync with anything other than excesses that will have to be ironed out down the road.
What's the takeaway for investors to all of this?
My takeaway is the same I put out in my market strategy report for the last 3 months. You should be selling your chip stocks. Don't don't not sell your chip stocks, Terry. I think the rest of it is going to be, if it is a bubble and it looks like 99, the other thing to realize they're going to be massive, like we've seen today. We're talking on, Thursday, July the 30th, with 15% moves up in these chip stocks. You should expect that. That is exactly what happened in 2000. Big counter trend rallies, but then play out, and then we head back down again.
Next are three Zacks number one strong buy large cap stocks, starting with the most overvalued large cap stock and ending with the most reasonable. Applied Materials, Cisco Systems, and Alphabet.
Yeah, so what we've got here, Terry, is these shares of these companies that are in this chip space. And I want to start off with Applied Materials just to give you an idea of how crazy this is. We're now at $440 a share. Just a few weeks ago, 30 days ago, we were at $640 a share. So we've already lost $200 a share. These things traded, middle of last year at $200 a share. So we have another $200 a share of earnings that can be wrung out of Applied Materials. Cisco Systems was the real corollary to the 2000 period, and now is Cisco Systems. And again, we were at $60 a share. Now I'm looking at $112 a share. This has just begun to sell off from $120 a share. And again, we can go all the way back down to $60 a share, Terry, which would be dramatic and very scary, very much something people have to be concerned with. Now let's take a look at Alphabet. It was at $400 a share a few weeks ago. I'm looking at $335, and I can get all the way back down to $200 on this chart. Again, another $135 a share to wring out of excesses. So if you own them, just get out of them. You didn't pick the top, but at least book your profits, Terry. That's what I would tell you.
Our chief equity strategist and economist, John Blank, on the AI CapEx boom. And with John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.